Let's get across the market open now. Kyle Rodder joining us from Capital.com, direct from London. Kyle, welcome back to you. Of course, the news that's just broken, the US launching fresh attacks on Iran. That's following up the promise from President Trump that he would do so if Iran didn't move on a deal. Have we seen much movement in terms of market reaction?
A little bit, but not a great deal. I mean, we did see a little bit of upward pressure on oil prices throughout the US session, and that seems to have followed through slightly into the Asia Open, which, I mean, the strikes more or less happened 15 minutes or thereabouts after the close of US trade. So it's still a fairly live situation, but the oil price has probably moved less than one would suspect. There is perhaps a lack of detail here in terms of what the nature of the strikes are. There is some reports that perhaps they are really limited to defense and military assets, that they're not very expansive, that they're very limited and not a major risk to energy infrastructure. So that could be one of the reasons why we haven't seen a massive gap higher in oil prices just yet. You know, the flip side of that is that this is a fresh story. There's complacency and the markets aren't really priced and pricing in appropriately, efficiently. There are risk of escalation here and a peace deal that gets, sort of kicked further down the road and an oil market that is only strained even further. So again, live situation, the market movements haven't been very significant just yet, but one suspects that on balance, this is going to lead to slightly higher oil prices and certainly make it difficult or more difficult for the US and Iran to reach a deal in a time frame that the markets are going to be happy with.
And elsewhere, in commodities, gold plunging as well.
Yeah, and I think there's probably two things happening here. One is obviously the interest rate story, and we had the inflation data out last night. It wasn't hotter than expected by any means, but it was pretty high, and also showed some signs that, maybe some underlying price pressures persist and only, well, if not add to the case for rate hikes from the Fed before the end of the year. It certainly didn't detract from it. So there's that whole element now that we've got basically gold responding to the expectations of rate hikes or the uncertainty around rate hikes from the Fed this year. The other side of it too is that I think one thing we're experiencing across markets at the moment is sort of having a small minor contagion effect, is this kind of deleveraging going on that I think is symptomatic of the moves we're seeing in equities, a fundamental impetus, of course, but a big deleveraging that's kind of exacerbating the size of the moves to the downside for equities, and that you're also seeing that kind of dynamic spilling to gold and some other assets that had, outperformed as well up until, obviously the start of this year. So it's really critical because we've broken a new low for gold. We might test 4,000 in the session ahead. And if we go through that level, pretty key psychological level, you might start to see some further momentum build into the downside, notwithstanding, in fact, that, the market is pretty oversold at the moment.
Interesting. I mean, you mentioned that latest inflation read, which obviously the price growth picking up yet again in May. But you take a look at the reaction of the Treasury market was fairly benign.
Yeah, it was fairly benign. I mean, the number itself was fairly tame. There's a few ways you can slice it, though. On the one hand, it was pretty much as expected. Maybe the silver lining was that the month-to-month figure was a little lower than forecast, about 0.2%. So you annualize that, and that seems to be, reasonably benign. The other side of that, though, is that this does mark an acceleration in inflation. The headline number jumped to a multi-year high. You've got core inflation at 2.9%. And I think watching the data drop this afternoon, my time, what you did notice was there was this sort of knee-jerk reaction of a jump in gold, a jump in equities, a drop in the US dollar after probably those numbers came through the headlines. But everyone started talking about the super core number shortly after that, the kind of number that seems to that is critical in terms of understanding the underlying inflation impulse, and then also some components in there that feed into the PCE index. And that was quite hot, suggesting that, again, there's these sort of simmering pressures that are eventually going to come to the surface and will necessitate rate hikes from the Fed somewhere down the line. So I think that was sort of the market's response, and, combined with the fact that we're in a position now where the Fed is probably going to be shifting its assessment of the balance of risks away from, labor market weakness, because there doesn't seem, at least according to the last two jobs figures to be much labour market weakness there anymore. It's going to shift more to this sort of inflation number, and with the labour market very little impediment to further rate hikes, a number like this, which at the start of the year might have been sort of brushed off because of the expectation that the Fed would focus on the labour market, that context has kind of shifted now, and there is that belief that a hike is going to have to come eventually. So that seemed to be the real kind of fact they're weighing on equities and gold, as well as again this kind of technical pullback that sort of started to gain steam at the back end of last week.
And it's interesting, of course, what's playing out on equities. I mean, obviously, a deeply negative session on Wall Street. Carl, the chip makers again leading those losses. Clearly, investors now concerned just about those evaluations. It's taken a while, but I guess we finally got there. And of course, this coming ahead of that SpaceX IPO.
Yeah, I mean, I think it's fair to say that sentiment was pretty bullish, and that, whenever you get these kind of very high profile IPOs, and SpaceX is, one of three. Obviously, we've got Anthropic there as well. OpenAI is increasingly talking about, coming to market potentially by the end of the year, most likely into next year. Is that you've got, companies wanting to tap public markets because there's the expectations that investors are going to have be very, very willing to part with their capital because there's, the narrative there that the returns are on offer. But, that potentially has a bit of a dilutive effect on the market sort of overall. And again, it's just a sentiment indicator that things are sort of a very bullish in the grand scheme of things, I guess. What I would say is that I think the market is still underpinned by very strong fundamentals, and that kind of last 5 to 10% of the rally that we saw going through May into the start of June looked very much like a market that was getting a little bit too far on the one side of the boat. A chart that was doing the rounds last week was the skew between put and call equity options across the S&P 500 stocks, and we were looking at almost unprecedented levels, which was to say that a lot of punters were more or less, buying calls to chase the momentum. And we're probably seeing a lot of that trade unwind now. And as a result, sort of having this kind of self-fulfilling move to the downside as some of that positioning is well balanced. So there is that kind of story that, things are getting a little bit hot in the market. People are concerned about valuations and maybe the dilutive effect of these new IPOs. But underneath it all, like I said, it's a pretty strong fundamentals. And I think this is really just a market sort of blowing off some froth for a little while, especially given that there's also the trigger there of just a little repricing of interest rate risks, which itself, is driven by inflation caused by the AI investment boom. So it's all sort of tied into one.